Welcome to the debate. Imagine a CEO who just delivered the most profitable quarter in their company's history,
Okay, a rare breed these days, but sure.
right? I mean, the numbers are off the charts. The quarterly report is just glowing. And yet, the board of directors fires them the very next morning.
Wow.
Why? Because in the complex world of corporate finance, making a massive profit today might be the exact thing that bankrupts you tomorrow.
Yeah, it happens all the time.
It really does. So today, we are diving into the mortar that holds the entire architecture of a business together, which is capital allocation. This is, the absolute core function of a finance manager.
The daily, rigorous science of managing funds.
Exactly. We're talking about acquiring finance at the lowest possible cost, making crucial liquidity decisions regarding current assets and liabilities, and critically, evaluating capital investments for profitability before a single dollar is committed.
And, it is not just a matter of keeping the lights on. Every single decision a finance manager makes, whether it is determining the form and timing of a dividend payment or predicting future financial surpluses and deficits, is a strict test of efficiency.
Right.
It is the operational reality of dealing with financial markets to raise funds and ensuring those funds are properly utilized. I mean, if you get capital allocation wrong, the business ceases to exist, period.
Which brings us to the foundational crack we are examining today. When we evaluate whether capital allocation was successful, what is the ultimate foundational objective that should actually guide a firm's decisions?
$1 million question.
Literally.
Well, I argue that wealth maximization, which we also call value creation or present worth maximization, is the only superior and comprehensive metric.
Of course you do.
I mean, it is. It's the only framework that guarantees the efficient allocation of resources because it demands a long-term view. It properly accounts for the inherent risk of the business and the time value of money.
Well, I take a much more pragmatic stance. Profit maximization is the ultimate, indispensable foundation.
Indispensable?
Yes, indispensable. It is the definitive parameter for evaluating business efficiency and ensuring successful capital allocation. The main aim of any business, before anything else, is to earn a profit.
Well,
Without it, the entire discussion of, abstract value creation just collapses into academic daydreams. Academic daydreams. Okay. Let's break down the mechanics of why wealth maximization actually works in the real world. If a finance manager is evaluating a capital investment, say, building a new manufacturing plant, they cannot merely look at what returns cash tomorrow.
Well, they have to look at it a little bit.
But successful capital allocation inherently requires a long-term objective. When we rely on wealth maximization, we are focusing on improving the actual, underlying value of the shareholder's investment.
Okay, but how are you defining that value?
We define it because wealth maximization intrinsically considers a foundational rule of finance, which is the time value of money.
Ah, yes. A concept often thrown around but rarely grounded in immediate operational reality.
But it's the math that dictates reality. I mean, the time value of money simply recognizes that $1 in your hand today is worth more than $1 promised to you tomorrow.
Sure.
Why? Because of inflation and because of opportunity cost. You could invest that dollar today and earn interest on it. Wealth maximization rigorously discounts those future cash flows to understand their true present worth.
Right, but
And more importantly, it considers the risk profile of the business. It ensures that capital isn't squandered on short-sighted gains that might temporarily inflate the balance sheet, but ultimately jeopardize the firm's survival over the next decade.
I understand the theory, I really do, but let's look at how resources actually behave. You are treating profit as if it is some short-sighted, crude metric.
It kind of is.
But in reality, profit is the main source of finance. Before a finance manager can even dream of discounting future cash flows or managing working capital, they need actual liquid funds.
Right.
And where do those funds predominantly come from? They come from the profitable operations of the business today. Profit is the parameter of measuring the efficiency of the business operations.
But it's not the only parameter.
In fact, if you look closely at the fundamental arguments for wealth maximization, it is essentially just an indirect name for profit maximization.
An indirect name? I have to push back hard on that. They lead to entirely different decision trees.
But they are intrinsically linked. The ultimate aim of wealth maximization is, at its core, to maximize profit over a timeline. Wealth maximization can only be activated with the help of the profitable position of the business.
Well, yes, you need some profit.
You cannot maximize the present worth of future cash flows if your current operations aren't generating a surplus. To pretend that wealth maximization is a completely independent, superior paradigm ignores the fact that it sits entirely on the shoulders of basic profitability.
Okay, but
If your core engine isn't making money, there is no wealth to maximize.
look, profitability is a component, yes, but prioritizing profit maximization as the primary guiding objective is fundamentally dangerous. It is, by definition, a short-term objective.
Not necessarily.
It is. Let's use an analogy. Profit maximization is like driving a car by only looking at the speedometer. You might be going 90 miles an hour right now, which looks great on a quarterly report, but you have absolutely no idea if you're heading toward a cliff.
Okay.
Wealth maximization is looking at the GPS, the fuel gauge, and the road ahead to ensure you actually reach the destination without crashing. If a finance manager evaluates a capital project strictly through the lens of maximizing immediate profit, they are going to ignore the time value of money and they are going to ignore long-tail risks.
But let's follow your car analogy. If you don't have any gas in the tank, right now, your GPS is completely useless.
Well,
You are stranded.
right, but getting gas is an operational necessity, not the ultimate destination of the trip.
Fair enough.
Think about capital allocation like a farmer managing a plot of land. Prioritizing short-term profit is like a farmer choosing to harvest crops before they mature.
To get some food, yes.
Sure, you secure an immediate yield to show the market today. You get cash in hand, but you completely destroy the long-term value and capacity of that field. You leave the shareholders with a barren plot of land next season.
But what if the farmer is starving today?
Well,
What if the bank is coming to foreclose on the farm tomorrow morning? Your farmer analogy is poetic, but it ignores the immediate operational risk.
it doesn't ignore it. It's just,
One of the primary mathematical arguments for profit is that profit reduces the immediate risk of the business. If you don't harvest something to sell today, you face an immediate liquidity crisis.
I agree, liquidity is important.
Right. The finance manager's job includes managing liquidity decisions, like managing current liabilities, paying suppliers, meeting payroll. If you are entirely focused on this idealized long-term horizon, you might not survive the short term.
Yes, but
The long-term wealth maximization becomes utterly irrelevant if the firm goes bankrupt next month because it prioritized distant value over immediate cash flow.
Okay, let me pause and play devil's advocate against my own point for a second, because I want to make sure I'm wrapping my head around your argument.
Go for it.
Are you saying that short-term survival mathematically overrides long-term present value in all capital allocation decisions?
I'm saying that survival is the prerequisite for value. If you're listening to this and running a small business, you know exactly what I mean. You can have a 10-year business plan that guarantees a $1 billion valuation, but if you can't make payroll on Friday, you don't have a business on Monday.
right.
Profit maximization ensures you meet those immediate hurdles. It forces a discipline that abstract wealth creation models often just, wave away.
I hear you, but the problem with setting up the entire corporate structure to chase that immediate survival metric is that it ignores the behavioral realities of corporate management.
What do you mean?
Well, if we want to discuss capital allocation success factors, we have to talk about agency theory.
Ah, yes.
This is the inherent conflict of interest between the principal, the shareholders who actually own the company, and the agent, the management and board of directors who run it day to day.
The classic disconnect, the agency problem.
Exactly. Shareholders provide funds to get better returns in terms of profits and dividends over the life of their investment.
Right.
But they don't manage the day-to-day capital allocation. Managers do. And management might decide to make harmful financial decisions based on their own incentives.
Sure, that happens.
So when you use profit maximization as your guiding star, you actively exacerbate the differences in evaluation horizons between the owners and the managers.
Because of compensation structures.
Precisely. Managers are often paid a fixed salary with bonuses tied to annual or quarterly performance.
Yeah.
They want immediate credit for their work. If they are evaluated on short-term profitability, they will preferentially select short-term projects. They will harvest the unripe crops to secure a quick cash bonus, completely ignoring that shareholders prefer long-term projects to maximize their actual wealth over time.
Okay, but
Wait, think about it. A CEO might slash the research and development budget to zero.
Boom, profits skyrocket this year, the CEO gets a massive bonus and then resigns.
Right.
5 years later, the company has no new products and goes bankrupt. Wealth maximization solves this incentive problem by perfectly aligning the firm's evaluation metrics with the shareholders' preference for enduring long-term value creation.
I have to challenge that, specifically regarding how wealth maximization actually functions in the hands of those very same agents.
How so?
You claim it aligns incentives, but the financial realities point out highly unfavorable consequences of wealth maximization precisely because of the agency problem.
Really?
Yes. One of the major criticisms is that under the guise of, quote, wealth maximization, management alone enjoys certain benefits, and it actively creates ownership management conflict.
How so? The objective is mathematically defined as maximizing the present value of future cash flows for the shareholder.
In theory, yes. But in practice, wealth creation and present worth are inherently subjective, forward-looking metrics.
I wouldn't call them subjective.
They absolutely are. They rely on discount rates, projected growth, and endless assumptions. They are incredibly vague in practice. When unobjective is that long-term and nebulous, managers can hide behind it.
I mean,
We see this all the time. Conflicts arise due to what economists call the consumption of perquisites. Perks.
oh, sure.
A manager can justify buying a fleet of private corporate jets or lavish office buildings by claiming it's necessary for brand prestige and long-term wealth creation.
But the market eventually punishes those inefficiencies.
Not before the capital is misallocated. Think about mergers and acquisitions.
Okay.
A CEO can easily justify buying a rival company at a massive premium, actively pursuing an empire-building power goal just to stroke their own ego, all while claiming to the board it's for synergies and long-term wealth maximization.
Well, profit maximization is far less vague. It is a strict mathematical constraint. You either increased the operational efficiency and earned a higher margin this quarter, or you didn't. Profit maximization prevents managers from hiding creative accounting and self-serving perks behind the theoretical shield of a 10-year plan.
I disagree that profit maximization isn't vague. It is actually cited in core financial principles as being ambiguous itself.
How is it ambiguous?
It is never entirely specific on which profit is to be maximized. Are we talking about gross profit, net profit, operating profit, earnings before interest and taxes?
Well, you define that at the board level.
Focus on immediate profit leads directly to unsustainable, value-destroying practices.
I don't buy that.
If you mandate that a manager must hit a specific profit target this quarter, it encourages the exploitation of workers, the shortchanging of consumers, and creates fertile ground for corrupt practices.
You're assuming profit requires exploitation, which is a fallacy.
I'm not saying it requires it, I'm saying an obsession with short-term metrics incentivizes it. And this brings us to a crucial element of capital allocation, which is how a firm handles non-financial goals.
Okay, let's go there.
We're talking about the welfare of customers, employees, the government, society, competitors, and suppliers.
The stakeholders.
Yes. Successful capital allocation under wealth maximization seamlessly integrates these non-financial goals because they mathematically complement one another over the long horizon.
I think that's a stretch.
Let me challenge your framework then. How does a pure profit motive justify allocating capital to employee welfare?
Well,
If you spend $10 million upgrading employee facilities and healthcare, under profit maximization, your profit just dropped by $10 million. You failed.
temporarily, yes.
But under wealth maximization, the logic is clear. When a firm satisfies its employees through a good working environment or comprehensive benefits, there is a massive reduction in agency cost and turnover. You retain top talent.
Sure.
That directly leads to an increase in the profitability and stability of the firm over a 5 to 10-year horizon.
That is a very optimistic reading of how resources behave in the real world.
It's not just employees. Think about the community. When a firm satisfies society through the provision of social amenities or environmental sustainability, society provides a stable operating environment.
Okay.
You get a reliable labor pool and goodwill that reduces regulatory friction. Allocating capital to these non-financial goals actively complements long-term wealth creation. It is a calculated investment with a measurable return, not a sunk cost.
I understand the mechanism you're describing, But have you considered the inescapable trade-offs?
What trade-offs?
Resource allocation is by definition a zero-sum game in the short term. Every dollar spent on an amenity is a dollar not invested in the core product. But the reality is that these non-financial goals actively conflict with one another and directly reduce profitability.
I don't deny there are upfront costs, but they are necessary risk mitigation expenses for long-term survival.
They aren't just risk mitigation. They are direct conflicts with the firm's financial requirements. Let's look at the actual math on the ledger.
Okay, let's do it.
When a firm satisfies its employees through the provision of high pay and fringe benefits, there is an immediate, direct increase in cost, which lowers profitability.
Right.
When you satisfy customers through heavy discounts or permanently lower prices, there is a direct reduction in revenue.
Yes.
And what about the government? Satisfying the government through the timely payment of taxes rather than legally deferring them means a lost investment opportunity. Cash leaves the firm today that could have been used to generate compound returns tomorrow.
But wait, aggressively avoiding taxes or underpaying employees introduces massive structural risk to the business.
Sure.
A sudden tax penalty or a labor strike will devastate the stock price. Wealth maximization strictly accounts for that risk probability.
Yes, but only rigorous profit maximization ensures that the firm's capital isn't bled completely dry by the competing demands of all these stakeholders simultaneously.
Bled dry?
Think about it. If you try to beautify the environment, provide generous scholarships, build social amenities, pay top-of-market wages, and offer the lowest prices to consumers, all noble non-financial goals, sure, there will be an immense, unsustainable increase in cost.
Obviously, you have to balance it.
If you satisfy competitors through uniform, perfectly ethical pricing rather than aggressive market capture, there is a reduction in revenue. You cannot be everything to everyone without destroying the financial engine of the company.
So you're saying social responsibility is antithetical to business?
Not at all. In fact, one of the primary arguments for profit maximization is that ultimately, profitability is what actually meets the social needs.
How so?
Think about it. A bankrupt company provides zero jobs. It pays zero taxes. It builds no schools and funds no pensions.
True.
By ensuring the firm remains a hyper-efficient, profit-generating machine, it organically fulfills its societal role. The profit is the engine that allows for the taxes and the wages to exist in the first place.
Let me give you a different perspective on how those conflicts actually resolve in a functioning market.
Go ahead.
It's true that ethical pricing or robust employee benefits require cash outflows today, which looks like a lost investment opportunity on this quarter's balance sheet.
Yep.
But a finance manager's role in making investment decisions is to establish the true profitability of a project before committing funds, factoring in all risk variables.
Okay.
If a firm operates unethically to maximize short-term profits, say using cheap, toxic materials to save a buck, it radically increases its risk profile. The time value of money, which relies on discounting future cash flows, only works under the assumption that the firm will actually exist in the future to realize those cash flows.
A fair point. If the company is sued into oblivion, future cash flow zero.
Exactly. Wealth maximization forces the finance manager to balance these non-financial goals precisely because ignoring them destroys long-term shareholder value.
The capital allocated to customer satisfaction, like incredible after-sale services or higher quality goods, means customers become loyal advocates for the firm. They buy more, demand increases, and sustainable revenue follows.
Sure, in a perfect world.
It is a virtuous cycle. Strict profit maximization, where you slash customer service to save money this quarter, is a vicious cycle. You boost margins today, but next year, your customers flee to a competitor.
Okay, but we keep circling back to this idea that long-term wealth maximization is a flawless cure for bad management, and we've already established it isn't immune to the agency problem.
It's not flawless, but it's better.
You mentioned the conflict between shareholders and management. Let's look at the actual solutions provided in our financial frameworks for the agency problem.
Okay.
How do we practically fix the incentive problem, where most managers are paid a fixed salary and aren't inherently motivated to maximize shareholder value?
Well, we align their interests with the shareholders.
Yes, through performance-based compensation. We tie their bonuses to specific, measurable metrics. And while that can be tied to long-term stock price,
The daily operational targets they are held to are almost always profit-driven.
Right.
You measure the efficiency of a factory manager by their profit margin, not their 10-year wealth creation theory. Furthermore, let's look at the other structural solutions to the agency problem.
Like what?
The threat of firing or the threat of a hostile takeover. These mechanisms are highly immediately sensitive to profitability.
Actually, walk us through how a hostile takeover plays into this, because I think it really supports wealth maximization.
Well, it's driven by profit failure. If a management team is supposedly, maximizing long-term wealth, but producing miserable quarterly profits year after year, what happens?
The market corrects.
Exactly. The market loses faith. The stock price drops. The firm becomes undervalued relative to its assets.
Right.
They become a prime target for a hostile takeover by another firm, a corporate raider who looks at the balance sheet and says, we can run these assets more efficiently and generate immediate profit.
Yeah.
They buy the controlling shares, fire the incumbent management, and restructure. The threat of that happening forces managers to maintain profitability today.
I actually think this brings us to a fascinating point of convergence.
Oh, really?
Yeah, whether a finance manager is operating under the philosophical banner of wealth maximization or profit maximization, we both agree that the greatest systemic threat to capital allocation success isn't just market dynamics, it's the human element.
Oh, absolutely.
It's the agency problem. The misalignment between the principals providing the funds and the agents deploying those funds can destroy any financial strategy, no matter how elegant the math is.
Definitely. Whether it's the board of directors acting against shareholders, multinationals stripping value from their subsidiaries, or even shareholders acting against creditors by suddenly taking on massive risky debt.
Right. The conflict of interest is the primary friction in financial management. Capital allocation doesn't happen in a vacuum, It happens in boardrooms full of flawed human incentives.
And the solutions remain universal across both our frameworks. Performance-based compensation is required to fix the incentive problem.
Yep.
The very real threat of firing ensures accountability to the owners, and the threat of a hostile takeover allows the broader market to aggressively correct chronic inefficiency.
Exactly right. These mechanisms are the guardrails. They force management to act in the economic interest of the firm as a whole, rather than pursuing personal power, self-esteem goals, or hiding behind creative accounting.
So as we step back and look at the entire life cycle of a business decision, I maintain that capital allocation can only truly be considered successful if it maximizes long-term shareholder wealth.
Shocking.
Well, a finance manager must make financing, liquidity, dividend, and investment decisions by rigorously accounting for the time value of money and the risk of the business.
Sure.
By aligning management's horizon with the shareholders' horizon, wealth maximization ensures that the firm doesn't just survive today, but creates enduring, compounded value for the future. It recognizes that a business is a marathon, not a sprint.
And I maintain that profit maximization remains the indispensable beating heart of the business.
Okay.
It is the actual, tangible source of funds, it is the strict parameter for measuring operational efficiency, and it grounds abstract, long-term financial forecasting in hard reality.
I guess we'll just have to disagree on the priority.
Without the immediate discipline of profit, firms risk drowning in the vague promises of future wealth while failing to meet their present liquidity requirements. You can't run a marathon if you stop breathing in the first mile.
Which highlights just how complex financial management truly is. Every single capital investment, every dividend payment, every agonizing decision about current assets requires balancing these inherent contradictions.
It really does.
We encourage our listeners to dive deeper into the mechanics of these foundational theories to explore how they play out in the chaotic, high-stakes reality of global financial markets.
Because ultimately, whether you are trying to build a towering legacy for the next century or just trying to keep the factory lights on this week, you have to ensure the math actually works today.
Precisely. If you harvest the crops too early, you destroy the field's potential.
True.
But if you ignore the realities of the harvest entirely, the farm simply doesn't survive the winter.